So if you have some cash right now, some dividend stocks in Canada right now I believe are a great bargain. We're seeing some absolutely ridiculous dividend yields. And these stocks aren't even REITs, which historically provide the highest dividend yields. So if you do have the cash, the following 3 stocks I believe are the biggest bargain to buy right now if you want dividend stocks. So let's start off this list with Scotiabank. Canada bank stocks these days has seen a drop, which is understandable since the interest rates has gone up, which causes volatility in the market. Consumer spending drops, so the need for loan obligation drops as well. Even though all 5 major banks in Canada has seen their share prices drop this year, Scotiabank stock got hit the hardest, down 10% since the beginning of 2023 and over 16% in the past 5 years. In fact, it's the only big 5 bank stock in Canada with a PE ratio of under 10, closer to 9 actually. If you didn't know, the PE ratio is the most common representation to see if a stock is overvalued or undervalued. I mean, it's not always accurate. Correction, most of the time it's not, but people still use it. The 4 other banks are above 10. Not a huge difference, but still noticeable. The dividend yield for this stock is the main selling point at a staggering 7.17%. You see, Scotiabank's approach from my research is a little bit different for the other banks. They invest heavily on foreign emerging markets, like Latin America, which makes Scotiabank's stock a little bit more risky than their competitors. But I think there's a good reason for their approach. With the US slowly shifting their manufacturing base away from China, these emerging markets could see a significant growth. And Scotiabank is in prime position to take advantage of that. And recently, Scotiabank did announce a 3% worldwide layoff. Listen, I hate it when companies, especially corporates, do layoffs because I was a victim myself before. But the truth of the matter is, layoffs do help stabilize the company's financials. But here's the thing. You know, the Scotiabank stock right now is so beat down, I can't see it get any worse. Maybe a recession, but the stock's probably already priced in for a small recession. That being said, if their investments in the emerging markets do prove successful, they have like the highest upside of any banks out there in Canada. Next stock is Telus. Telus stock has been on a huge decline since about a year and a half ago. The stock's currently at about $24 a share, and the dividend yield at exactly 6%. Now, this is the one stock where I believe that the drop has been a little bit exaggerated. So the drop of the stock has mainly been due to the increased competition. With the merger of Shaw and Rogers, Telus is like the distant third right now in the telecommunications industry in Canada, after Bell and Rogers. But there's still a major player in Canada which only has 3 major players. Basically a triopoly. Wait, is that even a word? Triopoly. Oh, it is. So yes, I'm not making stuff up. Now, they just released their 3rd quarter results. Let's take a look at it. They had a 75% drop in net income, but it kind of makes sense due to restructuring, because earlier on this year, Telus laid off like 6,000 staff. And again, layoffs suck. I would assume that having to pay off all that severance and having other financial costs due to rising interest rates hurts the net income in the short term. However, dividends increased for another quarter, nice, which means that Telus is confident with its future prospects. And if you didn't know already, Telus has been increasing its dividends for the past 19 years, close to becoming a dividend aristocrat, cause you need to increase your dividends for 25 years to become a dividend aristocrat. But Telus is getting close. I'm actually not too concerned about the 75% drop in net income for the time being. To me, this seems like a short-term situation which would not really carry on into the future long-term prospect. And again, Canada operates the telecommunications industry as a triopoly, and Telus is not going anywhere. Even though there's increased competition, but come on guys, it's Telus. Plus, Canada is increasing in population, growing by like 1 million people a year, mostly through immigration. So I believe that the telecommunications market in Canada will continue to grow, and Telus will be in a good state. So $24 a share, that's a bargain, really. The last stock is TC Energy Corporation. At a share price of just under $50, you're getting a dividend yield of like 7.45%. Over the past year and a half, the stock price dropped by over 30% from $73 last May to under $50, just a year later. Now, their main reason is their Coastal GasLink pipeline project. Essentially a natural gas line project crossing through the Rockies to be exported to the Asian customers. The original cost was $6.6 billion. Delays and legal issues caused the project to balloon up to $14.5 billion.
Oh, damn. That was a lot.
over 2 times the original cost. With inflation going up, the cost of borrowing money is going to go up. So yeah, it's actually easy to see why the stock price suffered in the past year or so. But the good news is that the project is very near complete. The stock has seen its dividends raised for the past 22 years, and there's been no announcement that this will stop anytime soon. As we expect the interest rates to fall in the future, borrowing becomes cheaper, and I would assume this will help the stock price of TC Energy as well. So yeah, those are the 3 stocks I believe are a bargain to buy right now if you're looking for a cheap dividend stock in Canada. It seems to me that the market has overreacted to certain situations which caused the share prices of these companies to drop so much, giving you really high dividend yields. So yeah, that's it for today. Please remember to like this video as well as subscribe to my channel. I make financial tips for Canadians in my long form content and financial comedy in my shorts. Thank you all, and I'll see you next time.